The trades you are seeing right now doesn't care about the direction of the market, because even though the market goes up or down, we are still going to be in profit at the end. That is the advantages of statistical arbitrage. And in this video, I'm going to show you how to spot statistical arbitrage on Bybit exchange automatically. So let's start. Statistical arbitrage, as the name implies, involves trading the difference between two assets, which is the spread of two assets based on the statistic of that two assets. What did I mean? Now imagine you have two trading symbols, which is BTC and ETH. These two symbols are different assets, and statistically they might have something in common. What did I mean by having something in common? Imagine the price of BTC is moving in this direction, and then the price of ETH is also moving in a similar direction. It means when ETH is going up, or when BTC is going up, ETH is also going up. And we can say that these two pairs, which is BTC and ETH, are positively correlated because they are moving in the same direction. But what if in a scenario in which when BTC is going up, ETH is going down? For example, like this. So in this scenario, we can say that these two pairs are negatively correlated, because when one is going up, another one is going down, so they are negatively correlated. But what if in a scenario in which BTC price is moving and ETH price is also moving, but they are not moving in the same direction, like going when BTC is going up, ETH is going up, and vice versa? What happens is that they have a relationship on the price movement. It means they are moving in a certain range. They do not move out of the range. In this scenario, we can say they are co-integrated, because they are not actually moving in the same direction but in the same range. So they are co-integrated. So what we are going to look for in a co-integrated pair, which is a pair that is moving in the same range, is that we are going to find a period of time in which they deviate out of the range. Maybe BTC is moving out of the range that they normally move, or ETH is moving out of the range that they normally move. And in this scenario, we can say that the spread has widened out of the mean. Remember, the spread is the difference between BTC and ETH. So at this point, they are widened, they deviated out of the mean. And the idea in this scenario is that what is always true statistically will normally hold true. So now that these two symbols are deviated out of the range in which they are always moving statistically, we want to trade the spread and hoping for it to convert back to the mean that they are normally moving statistically. That is how statistical arbitrage works. So for us to trade the spread, we have to calculate something known as z-score, which is how the spread is widening up or down. And we also need to know the average period of time in which, when these pairs deviate out of the range, it goes back to the mean statistically. That is known as half-life. So we are going to use the half-life to know when the spread is deviate statistically, how long does it take these two symbols to go back to the mean. And we are going to use the z-score to measure how the spread has deviated out of the mean, the duration, and how stretched is the band. So we are considering this deviation as an elastic band that is being stretched, and once it is released, it's always going to move again back to the mean that it was stretched. So whenever the spread is widened, it is stretched out of the mean. So we are going to then if, for example, that the stretch is happening in BTC, meaning BTC has moved out of, maybe stretch up out of the mean, then we are going to short BTC and then long ETH, expecting it to move back to the range. So we don't really care about the direction of the market, because we are trading the spread whenever the spread is widened, because the spread will always go back to the mean statistically as it used to. So how do you find co-integrated pairs in a cryptocurrency exchange? In the case of this video, let's dive in and see how we can find those co-integrated pairs and find when the spread are being deviated from the range that it always move in, which is the mean. So from here, I have my statistical arbitrage for CeFi exchange code right now, which is still a prototype, which is not done yet. And from here, this is the main.py file. I have the necessary imports. I'm currently using CCXT to connect to different centralized exchanges, in this case Bybit. And I have my exchange instance here, which I instantiated with my Bybit API key and secret. Take note that your API key should always be kept secret. So I'm just showing these API keys because I'm going to delete this API key and recreate another one after I uploaded this video. So then I have a module instance, which is a class I created for this bot, which is going to hold the functionality of this our bot in the memory. So we are going to instantiate the module class with the constructor of the exchange that we created here, as well as the user, which is me as the user of this bot at the moment. And from this main function, let me zoom it so we can all see. Here we have the main function in which we fetch derivative symbols. So this function, which is from the module class, just goes ahead and fetch all the symbols in Bybit for this case, and then sort the symbol by tradable derivative symbols, and is also going to return a dictionary of the symbol and an array, which is a list in Python of the size limit, which is the minimum size you can trade, the precision of the symbol, and contract size, as well as the max leverage of the symbol. So I am going to print this to show you what it shows in the terminal. So I'm going to run this. And remember to exit the code. Okay, let's pretty print. Okay, then from here you can see we have a pretty print of the symbols, which is all tradable derivative symbols in Bybit, and we have the list of the properties that we listed here and all the symbols. So what we are going to do after getting the symbols right now is that we are going to pass that symbol into this data frame. This is a pandas data frame that just structure the symbols in a data frame so that we can have the symbols as well as the close prices of the series. So we are going to have a data frame which is like an Excel format data frame, in which we are going to structure the symbols and the close prices for a specific time frame. So we are going to have a time series of all the symbols. That's what we are doing here. So we pass in the derivative symbols, and by calling the keys method to get only the symbols from this dictionary. And then I am going to console.log. Let's print this getting data frame market close prices, and then I am going to print this to the console. So I'm going to print this data frame market, not pretty print because it's already a data frame. This is going to take a very long time to print, some time, maybe 1 minute or 1 minute and above. So I'm going to pause this video right now, and then once it is done, I'm going to resume this video. And if you would like to run these bots whenever it is done, put it in the comment section that you would love to run this bot. I'm going to send you this bot absolutely free of charge whenever the development is completed. So do well to subscribe to this channel, like the video, and then comment down below if you will want to run this bot after it is completed. So I'm going to go through the comment section to send you this bot whenever this bot is available to the public. Okay, so from here we can see the output of the data frame market close prices. So we have the timestamp, which is the time series of the bars in each of the symbols you are seeing on the screen right now. In the case of this, we have this number AI Dodge and this and ZE up to 500 rows, which is 500 candles of almost 409 symbols, which is in this case 408 symbols, which are the derivative symbols tradable on Bybit exchange. So we have all the symbols, and the data frame shows the close prices of these symbols as well as the time in which the price was closed. So we are pairing it to a time series of the same candles on the same time. So when we are done with that, we are going to call this module.scan for co-integrated pairs. So this function is the function that is going to see from the list of this data frame of the symbols we have here, which of them are co-integrated, which means they are moving in the same range. So that's what this function is going to do right now by passing on the data frame market close prices that we have here in this screen. And then we pass in the derivative symbols to get the list that we have here, which is the limits and the contract size of the symbols, and then we pass in the max half-life. So we are telling this function, whenever you are searching for co-integrated pairs, and whenever those co-integrated pairs deviate out of the mean, we want the one that doesn't take more than 18.5 hours to go back to the mean when they deviate, to convert back to the mean. So if by statistic the pairs that deviate out of the mean, which is the spread that widen, takes longer than 18.5 hours to go back to the mean, which in this case, since we are using the 1 hour time series, which is 1 hour chart of the candlestick on the chart, so this is going to be represented in hours. So we are saying 18.5 hours. If it is more than 18.5 hours to go back to the mean, which is to convert back to the mean, then we are not interested in trading those pairs. So if I run this code right now, it's going to go ahead and scan for co-integrated pairs, in which if I go to the definition in the module class, so we can see here, this is the module class, and we have this scan for co-integrated pairs, passing in the market close prices that we got. And what we are going to do is that from this function, it creates a co-integrated pair list in which we are going to store all the pairs that has the maximum half-life that we specify here, which is 18.5 hours. And from here, what we are doing is that we get all the symbol lists from the symbols that we pass in, which is the list of all tradable derivative symbols in Bybit. In this case, we get all the symbols and we shift the time series out from the list that we are going to get. So remember, the zero index is going to be the time series, which is this timestamp. So we are going to shift out and start from index 1, which is the symbols, and that's what we are doing right now. So from here, we are going to start searching for the best pair, which is going to be the first pair, and then we loop all the pairs from this pair list. And when we are looping, we subtract the last index. So we don't want to loop into the last index, because we are going to start from looping the first pair on the list, and then we are going to switch over into this second for loop to loop the second pair. So this second loop is going to be the one that will loop to the last of the one we skip here, which is the last value. So we are going to get the series of the close prices of the base symbol, which is the first symbol, and we move on to the second symbol and get also the series of the close prices, in which what we are doing right now is that from this section, if we are starting from this pair right now, we are going to say loop this pair, and the second loop is going to loop from this second pair and loop all the pairs and see if this first pair and any other pair from the list are co-integrated. So that's what we are doing right now here. So the next thing we are going to do is that we are going to call this function calculate co-integration, and Then we pass in the series 1 and series 2, which is the series of the close prices of the two symbols that we are looping to see if those symbols are co-integrated. So if I go to the definition of this calculate co-integration, you're going to see the calculation here, in which I am not really going to go into details of the co-integration calculation, but just a quick overview. We are using the Python start module, and we are using the const function of the Python start module from here to calculate the co-integration. So when we calculate the co-integration, we get the quint value, we get the probability value and the critical value, and we use that to calculate the co-integration of the pairs. I'm not going to go into details of this because this video is just a short video, and there's going to be another video explaining how to do this calculation. So back to our model, when we calculate the co-integrated pairs from here, if the pairs that we are passing in the series into this calculate co-integration function is co-integrated, then we are going to see that the co-integration doesn't return null. So if it doesn't return null, it means there are co-integration in that series of pairs that we pass in. So we have the H ratio, we have the spread, and we have the half-life. Now the H ratio is the amount of series 2 you need to acquire series 1 statistically. So it does not really mean in the current market. It calculates how much of, for example, if series 1 close prices is BTC and series 2 close prices is ETH, this calculates in statistic all over the pairs or all over the bars that we pass in, or this time series. Statistically, how much of ETH do I need to get 1 BTC? So we are going to use that to calculate the amount or the price difference, because we can't use the price difference in ETH to calculate BTC. So we need to convert how much of ETH, which is series 2, we need to get series 1, so that we will be able to use the amount which is similar to the price of series 1 to calculate the spread. So that is H ratio, and the spread is just the difference between the series 1 and series 2, which is, for example, BTC and ETH. So we will say what is the price difference between these two pairs, and the half-life is once the price is deviated from the mean, how many hours in the case of hourly time series does it take to go back to the mean. Then here we check to make sure that the half-life is less than the max half-life that we pass in, and if that is the case, we then append this pair, which is the pair, to the co-integrated pair list that we created here to show that those pairs are co-integrated. So we have the half-life, the H ratio, and the properties of the base and quote symbol, which is the first symbol, and the second symbol, which is these properties that we have here. And when we are done with that, we want to come back here and check to make sure that there are co-integrated pairs. If the length is greater than 1, it means they are co-integrated pairs. And what we are going to do is that we are going to save that co-integrated pairs as co-integrated pairs.csv file, and then once we are done, we print that co-integrated pairs successfully saved. And if I navigate down here, you are going to see co-integrated pairs CSV, and if I click on it to open, you are going to see these are the co-integrated pairs that was fetched. We can see a base symbol, quote symbols, and the H ratio, which is this value. So in this case, it means in average statistic. Okay, let me navigate to non-exhaustive pairs. Okay, for example, here in this co-integrated pairs, this is the half-life. In this case, you can see the H ratio here, which is 0.3 approximately. So it means we need 0.3 of this symbol to get one of this symbol. That is what the H ratio stands for. We can see the half-life here, and we can see this symbol takes 14 hours to convert back to the mean whenever it deviates out of the mean statistically. This is what it means. And we have the base contract properties, which is the exchange specific properties of the maximum contract you can trade and the maximum leverage from this list. So that's what this co-integrated pairs CSV file is holding for all the co-integrated pairs. If we navigate back to our main.py py file. I am going to comment out this code right now because we don't need it. And if I navigate here, and you can see this point, we load the co-integrated pairs.csv file that we have here, and we have all the co-integrated pairs in a data frame format here. So what we are going to do is that since there are a lot of co-integrated pairs, like 6,000 pairs are going to be co-integrated, we can't go ahead and loop those pairs one by one, because it's going to take very long time to finish looping up all the pairs to check for trading opportunities. So we are going to paginate those pairs, those co-integrated pairs, by 100. So that's what we are using, split data frame. This function split this data frame into a chunk, which is the 100 chunk, and then it is going to save it into this tags, in which we are going to append the scan for co-integrated pairs and pass in the 100 chunk of co-integrated pairs into this tags, which is the tags we are going to run concurrently. Rather than running it one by one, we are going to split it into 100 each, and run all the co-integrated pairs concurrently by using this Python async IO. So that's what we are going to do here. And if I navigate to this scan for trading opportunities, we can see the co-integrated pairs. We iterate through the rows, which is looping through the rows, and we have the rows, all the rows of the co-integrated pairs. So we then have the base symbol, the quote symbol, which is what we have here. So all these rows that we have here, we are going to get the symbols, the everything here. So that's what we are getting from here. So we have the half-life, the hedge ratio for that specific symbols, and the symbol property which we have here. And from here, we are going to check to make sure that there's no open trades in this specific symbol, which is the base symbol or the quote symbol, by this exchange, by using the trade history JSON that we have in memory of our bot. So if there's position already open, we are not going to do anything or scan for trading opportunity for that co-integrated pairs. But if that is not the case, we are going to have a limit of maximum position we can open, which is going to be user specific. In the case of this prototype, we just put it to 5 maximum position, and take note that these positions are pairs. So a single position is going to be a pair of 2 different symbols. So that is single position, because we are doing pairs trading, we are trading the spread. That's why we don't care about the direction of the markets. So from here, we are going to get the data frame of the close prices, just the same way we got it back here when we were getting the close prices from this function here. Okay, I didn't comment out this, so I'm going to comment out this right now. So from this function that we got here, we are going to get the latest close prices, which is the current close prices, to use it and then calculate the spread. So just the way where we did the series 1 and series 2, and when we convert it to numpy array from here, and we check to make sure that the series are the same, they are unified. And when we are done with that, we are going to calculate the z-score and the spread again. So the spread is series 1 minus h ratio times series 2 gives us the spread, which is just saying series 1 prices minus series 2 prices. So this series 2 prices times h ratio means series 2 prices in form of series 1 prices. So that's what we use to get the spread, which is the difference between those two assets. So we then have this z-score, which is this function calculates z-score, calculate the z-score, which is how stretched is the elastic band of this spread or the prices. When the price are moving in the same direction, how is it stretched? That is what z-score is calculating. I am not going to go into the calculation for the sake of this video, and there's going to be another video for that. And once we are done, we are going to calculate from the z-score that we have what is the mean of the z-score, which is the average z-score. So we are going to have what is the average z-score, lower z-score, and the average higher z-score. We are going to save that into this variable and get the current z-score and the previous z-score to use it and calculate when the z-score is revising. and then we get the size that we are going to buy. For example, the base size, which is the series 1, we are going to buy it if the z-score is less than 0. It means the z-score is less than 0, but note that there's a threshold. It's not just when it is less than 0. So we have a threshold here, which is z-score threshold of 2. If it is less than 2, and then in average, we are going to calculate the average here, which is what we are going to use to determine our entry. So if that is the case, we are going to buy, and if that is not the case, that means the z-score is greater than 0, and we are going to sell the series 1 symbol. And then the opposite for series 2 symbol. If we are selling series 1 symbol, we are going to buy series 2 symbol, and if we are buying series 1 symbol, we are going to sell series 2 symbol. Now we are going to check the average of z-score statistically and then execute trade only if the current z-score is up to the average z-score statistically. So that's what we are checking here. But if it is not up to the average z-score statistically, we are not going to execute the trade. And this variable is what is going to store if the z-score is revising up or down. So in the case of buy, we want the z-score to revise up. When it is going down, it revises up. It shows a point of reversal. So that's when we are going to place a buy order, and the opposite is for the sell side, and we are going to place a sell order. But if z-score is not revising, we are not going to do anything. Stay with me, and I'm going to show you the visual representation of the graph of the z-score and spread. So currently now we have the current price of the base asset, which is series 1, and quote, which is series 2. And then we have our hard-coded size that we are going to buy, which is $5 in this case for testing purpose. And if you check the trade that was executed here in my exchange, you are going to see it all 5555. So that's the price, except these ones that the leverage has make it higher in the value, but in reality is 5 USDT that is used for the execution. Okay. From here, we are going to instantiate our trade class, which is a class that I created for trading. So we have a trade class that we instantiated and then save it here with the parameters of the series 1 properties and series 2 properties. Series 1 as the base symbol and series 2 as the quote symbol. And when we are done with that instantiation, we then have a trade instance which we are going to call to open position. So we call this trade.openPosition to open position. So we then have our position status. If it is error, we print this, but if it is not error, we then go ahead and save the position. And here we also save the plot of the z-score and the spread so that we see it visually. We save it to this trade history JSON, and we are going to print that position has been open. That is it, and that is how all these positions were open. And you can see from this, based on demonstration, all these trades could have been closed and we could have been in a huge profit because the z-score was revising to the mean that's supposed to close, which is the 0 line. Because I needed it to use it for the demonstration of this video, and the bot is still in development, so it's not yet done. And there's no function of closing trade at the moment, unless I will have to look at the z-score plot and then close it manually. On our main.py file, we have this model.manage all position. So this is where we are going to go ahead. And if I go to the definition of this manage position, you are going to see here that we have the number of position and we have the active position list, in which we are called from this function that gets the position properties, the current running position. So if I print this and then exit this code, you are going to see the positions that are running right now. So I'm going to clear this and then print it. Okay, so from here we can see our open position, we can see the total profits, we can see the unrealized profit as well as the realized profits. We can see total profits here for this symbol and all other symbols that we have. So that's what we have in a position disk, which is the properties of the current open position. I then loop into the trade history that we have and then get the trade history properties like the base and the quotes properties and the timestamp in which the trade was executed, the half-life and the symbol, and then we get the latest close prices data frame as we did before. Get it to numpy series and then passing into calculate the spread and the z-score, and then get the current z-score, and then from here I am going to show you the plot of the z-score when the trade was executed and current z-score right now. So we are going to plot it for the symbol, and then we are going to also show the current plot of the z-score and the spread. So that's what I'm going to do right now. So if I run this code right now, it's going to print the z-score for my other screen. So let's wait for it to print. Okay, I have the z-score printed in my other screen, so I'm drag it here. Okay, so if you see this, we have show image base 64, which is the z-score image when the trade was executed, which we got from the properties of the trade history. This is when the trade was executed, and this is the current one that we just plotted from the current z-score and the current spread. So we have it from the current z-score data frame, which we have here, and the spread right here. So if I navigate to the plot, we can see this is the current z-score and this is the current spread for this symbol, which is the symbol that we all have here, which is this symbol as well as value symbol. Value is going down, but we can see we are in a bigger profit because this one is canceling off the price, the loss of this one. That's why we are not really care about the direction of the market, because it will always cancel the loss of the previous one. So now if we check out our plot right now, you are going to see that this is when we entered on this symbol, and this is when the current price now. So you can see this is the z-score. You can see the z-score is showing statistically. You can see when it stretch, it revises back, and when it stretch, it always revises back to the mean, which is 0 line. So this is the 0 line of the z-score. So now when we enter this trade right now, this is when the z-score was stretched, which is like the elastic band was stretched out of the co-integrated pairs, and this is the co-integrated series of the spread. You can see how the difference is going. We can see the difference of FBUSDT and Velo USDT in this chart. So we can see the difference of the prices, and take note of this. Remember I said we could have closed the trade in profit, but I just decided to leave it for demonstration purpose for this video. You can see this is where we executed the trade, which is the entry from here. You can see the entry here, and look at how the spread or the z-score revise back to the mean. So we can see this is where we're supposed to close, which is the 0 line, but I did not close it. I just left it there for demonstration purpose. Now look at the spread right here. When we entered, the spread was going up. This spread is now showing the price difference of FB USDT and Velo USDT. In the case of this, FB USDT is less than Velo USDT. That is what is showing here, because the spread value is minus, which is negative. When we entered the position, the spread was here, which is down here. The spread is going down. It shows that FB USDT is undervalued compared to Velo. So now we can see the z-score right now. It's a perfect opportunity. Statistically, we can see once it deviates, it convert, deviate, it convert, and that's exactly how we get this trade that we executed. That's we got the FB USDT here, and we also have the Velo USDT here, which all cover up the profits. This is just the overview of how to spot statistical arbitrage on Bybit exchange or any other exchanges as the case may be. If you enjoy this type of content, please do well to like this video, subscribe to this channel, and let me know if you would like to test this bot in the comment section by typing in the comment section, I would like to test this trading bot, and I'm going to send you this trading bot, this statistical arbitrage trading bot, whenever the development is completed. Until then, see you in the coming video.